Thank you once again for joining us for another episode of Cam Harvey's Through the Noise. And I like just to get into it because it's just us two. So a while ago, several episodes ago, we had a wonderful discussion about the Fed. And somewhere in late January, I was watching the prediction markets on Polymarket, and in the evening, we see kind of the nominees for the next Federal Reserve chair, and we see this big spike. And I want you to tell us a little bit about, then the next day, Trump announced that this would be his new federal chair. And so I'd like you to talk a little bit about this nomination and what it means for the Federal Reserve and for us.
Sure. Yeah, very interesting, the role that prediction markets are playing in the economy. So this was 7 p.m. Thursday, January 29th, and the probability that Warsh would be nominated went to 0.95. So effectively, that information was leaked out. So overall, I think that all of the nominees were high-quality nominees. So there was really no bad choice. I think it's interesting that Warsh was chosen, given that he has got a very clear track record being on the Fed board from 2006 to 2011. And consistent with what we were talking about the last time, I share his opinion on the dangers of the Fed being too interventional. So Warsh is characterized as a non-interventionalist, and that's a view that I strongly hold also.
Can you help me understand what you mean by interventionalist? I think we discussed a little bit on one of our prior talks about ways the Fed intervenes in the economy, but what do you mean by interventionalist versus non-interventionalist?
Sure. So there is a time for intervention, and that's in the time of crisis. So the Fed is usually there, a lender of last resort, a provider of liquidity, and that is a traditional role. Mm-hmm. But things changed in the global financial crisis. It went well beyond a backstop, and the Fed engaged in unconventional policy, sometimes called quantitative easing. So the size of their balance sheet, which means what they're actually holding, the bonds, more than doubled, from less than $1 trillion to over $2 trillion. And a large part was the Fed buying bonds that were linked to mortgages. So this was a way, given the housing market was in distress. So again, during a period of crisis, I don't necessarily have a problem with some interventions, but once you're outside of the crisis, you need to dial back. And that's exactly what did not happen. So the quantitative easing continued. It continued throughout the years after the global financial crisis, and the Fed's balance sheet exploded. At the same time, short-term rates were driven to zero and held at zero from like 2008 and through 2016. And this was a time where there was robust economic growth, almost no inflation, and the stock market is at a record high. So it didn't make any sense. And then we got hit with the COVID-19 crisis. Again, there's a liquidity need. The Fed comes in and provides that liquidity. But again, the problem is what happened after that crisis. That recession was the shortest recession on record. They continued the quantitative easing. They continued this hoard of bonds and brought the balance sheet to $9 trillion. They drove the interest rate again to zero and held it to zero well into 2022. Again, at a time when the economy is growing, there's low unemployment, stock prices are high. Again, this type of intervention outside of a crisis, I think, is problematic.
So what I remember, because I was in business school around the time that during the financial crisis, is that the Federal Reserve said, "Hey, we don't have any more short-term rates to go. We're down at zero." And so this intervention was a way of continuing to control long-term interest rates So why is that a bad thing? It just sounds like another tool in their toolbox.
Then this is a bad thing on so many different directions. So number one, again, if you're outside of a crisis period, then to me it doesn't make sense to do this type of intervention. If our policymakers want to support, for example, the housing market, then that should be the responsibility of Congress. Mm-hmm. So in our democracy, those decisions should be made by elected representatives. But no, the Fed has taken a new role in the economy in fine-tuning outside of a crisis period and making effective policy decisions. So there are many unintended consequences of having very low rates. And let me just go through a few of them. So number one, it means that the interest that the government has to pay on their debt is low, and it allows them to borrow even more, which is not a great thing given the state of the debt in the U.S. being close to $39 trillion. So number two, a very low interest rate allows companies that should be out of business to survive. So these are companies that have a lot of debt, but given the rate is so low, they're able to survive. And it's much better for the economy for these zombie companies to go away and capital to be reallocated towards much more productive uses. Number three, and we see this playing out today, given that the rates were so low, people got mortgages at 1 or 2%. And there's a large chunk of mortgages outstanding, like in the 2% or less range. And while it's great for those homeowners, the unintended consequence is these people are largely frozen in their home. So the family might have a very good job opportunity in a different city, but given the rate is so low on their mortgage, they don't move. So this causes like a problem with productivity over the longer term. And then just number four, when the rates are so low, companies tend to invest in projects that would otherwise be marginal. Mm-hmm. So, this project's promising like a 5% return. In usual situations, the cost of financing is more than 5%. You would avoid that project. But no, given the distortion, these projects are pursued. So rather than investing in the 15 or 20% project, we get these very low rate of return projects. And what does that do? It spills all the way through the economy and it reduces GDP growth. So there's many unintended consequences.
So you're saying that our last, I'm just putting this together, you're saying our last two Fed chairs were very pro interventionalists, and that we're getting a brand new signal from the White House about the direction they want the Fed to go in.
Yes. So I think that this will change. And again, the Fed will be there if there is a crisis. But outside the crisis, intervention should be by the elected representatives of the people.
Well, thank you very much. This is actually not exactly the kind of insights I thought I was going to get from this discussion. But I'm very grateful to learn that this is the direction that the White House is signaling. So thank you very much for your time, and I look forward to talking to you next time.
Thank you.